we're becoming very surprised at how quickly the uptake of stablecoins is. So if we had to modify anything in that $1.5 million forecast, you'd probably see and you can see on a table in Big Ideas 2025 how we build up the bull case. We'd probably take a little bit from the emerging market part of that stack. I think we can safely say that our bull case is well over $1 million in 5 years.
Cathie Wood, welcome to CoinDesk Spotlight.
Thank you, Jen. I'm so happy to be here.
Well, we are so happy to have you. And here's why I want to start the conversation. If you think and can jog your memory, what's your earliest memory of markets, financial systems, and innovation really mattering to you?
Oh, goodness. In college, I didn't know what I wanted to do. So I tried everything. I tried engineering and education, geology, astronomy, physics. I just was,
You really touched everything.
oh my gosh, I did. And one of the reasons I did not take an economics class, probably, truth be told, is my father really wanted me to take an economics class. And so I waited until it was the last semester or trimester at UCLA of my sophomore year, took economics, fell in love with it, realized at UCLA that I wasn't going to be able to take more business classes because they just had a graduate business, transferred to USC, met Art Laffer. Maybe this is TMI, but whatever. Met Art Laffer, who is a famous economist, Laffer curve, who introduced me to Capital Group because he saw how passionate I was about economics. And Capital Group was the largest and most, I would say, probably still is, most prestigious investment firm in Los Angeles. And I walked in, I knew nothing about, how the financial world worked. But there I got the sense of, yes, here's where economics fit. Here's where this exciting market activity is. And, I think I fell in love with the investment world almost as soon as I walked in because I said, wait a minute. I and we are paid to learn. The world is our oyster. This is amazing. We get to figure out how the world's going to work. And I didn't have a doubt in my mind. After I was only 20 years old when I started at Capital, I didn't have a doubt in my mind that I would be in the business for the rest of my life.
What sparked that passion in economics? I mean, you tried everything. You're rebelling against your dad a little bit. Was it real?
We're so close, and we were so close, but it's just, teenagers do that kind of thing. What sparked it? I think Art Laffer has an unbelievable style of teaching. And when I transferred over to USC, he used to start the class off with a joke, kind of lure us all in, and then put whatever the topic of the day was going to be into context in the real world. Like, why are we doing this? And then, we got more into the theory. And by the end of the class, the board was full of equations. So he lured us in a very interesting way. And he also exposed us to the different ways of thinking about the world from an economic point of view. So Keynesian theory is associated with Harvard, and monetarism is associated with the University of Chicago. He was trying to plant a supply side school, more of an Austrian school at USC. But he wanted us to understand the differences among the various theoretical frameworks, which I loved because when I got into the business, I saw everyone was a Keynesian. Everyone. There were a few monetarists. They were considered rebels at the time. Now, this is in the late 70s, right? But Keynes, monetarist. And then I was able to watch the world move towards a supply side view under President Reagan. And thanks to my education, had a really good understanding that we were about to experience the most amazing stock market, really in history, I would say, in the 80s and 90s. So I think it was trying to understand why people in the business thought the way they did, and I did understand that. Of course, Art had a point of view about how incorrect some of those ways of thinking about the world were. And I was armed with that. I couldn't say very much about Art Laffer when I started in the business because, or when I moved to New York, which was in the early 80s, because supply side economics is one of the primary tenets, or the Laffer curve, is that if you cut taxes when tax rates are too high, you'll get more revenue. If you cut tax rates, you'll get more revenue. If you raise tax rates when tax rates are already too high and people are finding ways around taxes, you will lose revenue. And it didn't seem like it was working when we were in the recession in the early 80s because the Fed had taken interest rates. You think interest rates are high now? We ended up with interest rates at 15% plus, mortgage rates at 20% plus in the early 80s. And of course, that drove the economy into a recession. So it wasn't until a few years after I got to New York that I really could show my Art Laffer stripes in a big way. Of course, Jennison Associates, where I was at the time and where I was for 18 years, they knew because we would have Art Laffer in all the time to reinforce the point of view.
Midnight is introducing a novel approach to token distribution. The Midnight Glacier Drop is the first in a multi-phase distribution of the Night token aimed at empowering a broad, diverse community to secure the future of the Midnight network. Holders of ADA, BTC, ETH, SOL, XRP, BNB, AVAX, and BAT are eligible to participate in the Glacier Drop phase. Help usher in the next generation of blockchain with rational privacy and cooperative tokenomics on the Midnight network. To learn more about the Midnight Glacier Drop, visit midnight.gd and claim your night.
Well, I mean, just hearing about your experiences and the way you move through them, I'd love to just get your thoughts on where we are today. I know that the day that this is being recorded, the Fed in the US is deciding to keep rates steady. Just, I want to hear your perspective on where you think we're heading with rates.
Rates. Well, I think it was interesting in the Fed vote today, there were two dissents, and we have not had two dissents since 1993. And I remember those because I was in the business back then as well. And I think that's very important symbolically because Chairman Powell has wanted unanimity. And so now we've had a break. And part of it is because Chairman Powell's term is up in May of next year. And maybe the two governors dissenting want a shot at that position. You never know. You never know. But maybe it is because the two governors, and I haven't gone through all of the notes yet, the two governors are seeing evidence of housing relapsing here and prices in many areas not responding to tariff increases and seeing that, well, wait a minute, maybe the surprise here in the next 6 months is going to be much lower inflation. And we've had a few employment reports that they have something for everyone, some strength, some weakness. But I think what's beginning to concern a lot of people is that the unemployment rate for new college graduates is going up. And that's because entry-level positions are being subsumed in many cases by automation, especially AI. And so I think they're looking at this as a potential concern out there. We have been saying for quite some time that the economy has been in a rolling recession. When the Fed jacked rates up I think it's 22-fold in little more than a year's time, one sector after another began to give way, starting with housing. Housing, by many measures, is down 35% still from the peak. And we're seeing some metrics take another step function down. So I think that has some people concerned. I think the housing inflation numbers are going to come down. They're already, the monthly numbers that we get from various sources are showing declines. Year over year, they're not declining, except for maybe median existing home sales. But we do think that one of the solutions to the affordability crisis, if sellers really want their homes to move, they're going to cut their prices. And because that is if interest rates don't come down. And if they do cut prices, then the big surprise in the latter part of this year is how low inflation is going to go. And there's a big lag between the time home prices fall and they get into the statistics and leave the statistics as well. So this is going to be with us for quite some time. So I think we've been saying we believe that thanks to certainty now, more certainty about tariffs, tax policy, government spending, and regulation or deregulation, that we're getting ready to move from this rolling recession into a much stronger than expected recovery. In the next, I'll say 6 to 9 months, it will become obvious. With productivity, one of the biggest surprises, it's already strong given the slow growth rates in the economy. I think year over year, it's still up above 2%. But we think it's going much higher thanks to all of the technologies around which we have centered our research. So robotics, energy storage, AI, very importantly, blockchain technology, obviously important here, and what we call multi-omic sequencing in the life science space. All of those innovations are incredibly deflationary. And the best example probably is AI. AI training costs are dropping 75% per year. AI inference costs, so the cost to get an answer for as we're typing into ChatGPT or Grok, my preferred right now is Grok, those costs are dropping anywhere from 85 to, in China, we've gotten a statistic, 98% per year. So when you cut the cost of something, you get a lot more of it. So we think this is good deflation. This is not deflation like 08, 09. That was very bad deflation. This is good deflation for those companies that are on the forefront of these new technologies. It might be bad deflation for companies that are going to be disrupted. And if they're being disrupted, they'll be forced into cutting prices as well. Mm-hmm. So we think we're going into a much more deflationary world than I think many economists and strategists would suggest.
Talk to me about that 6 to 9 month outlook. Where does crypto fall into your vision for a stronger next 6 to 9 months?
The regulatory environment is very important here. We've gone from a hostile regulatory regime under Gensler at the SEC to a very, very friendly regime now, with legislation guiding regulators instead of regulation through enforcement, which was forcing innovation off U.S. shores to other countries. Now that's changing aggressively, especially appointing David Sachs, the czar for both crypto and AI. And this concept of agentic AI coming into view where, we will have our AI do all the walking and working and talking for us, up to a point, right? Because of agentic AI. And We need smart contracts because these agentic AI, our AI agents or assistants are going to be interacting with sites, maybe like CoinDesk, that, where we'll need to pay some money for something, one thing or another. And these are going to be automated smart contracts. Well, agentic AI is going to make that happen. So this is the convergence of AI and blockchain technology. But before that, what we're also seeing is a revolution in financial services. Thanks to the green light from regulators, more financial services companies are moving into the blockchain world because they realize it's much lower cost. So as I explain to our clients what's going on here, I like to back up because I remember this time very well. In the early 90s, late 80s, early 90s, when developers were first working on the internet, there was no idea that financial services or commerce would take place on the internet. And therefore, there was no payments layer. Now, thanks to blockchain technology, we have the payments layer. Over the last 30, 40 years, because we didn't have the payments layer, we needed to, and because financial services and commerce did migrate onto the internet in a very big way, the traditional world had to mitigate the risk of putting credit cards online and, trying to use traditional financial tools in this internet world. And all of the intermediaries involved have been taking anywhere from 2 to 3.5% out of each transaction, paid for mitigating the risk. We can probably drop that, and that's a tax on the system, right? We can drop that tax from 3.5%. These are US numbers. In Nigeria, the numbers would be 20% or more, right? Drop that tax from 3.5% to maybe 1%. And, the financial services world is huge. We think it's going to be a $250 trillion assets under management world in 5 years. So if you're talking about those kinds of numbers, taking 2 to 2.5% out of, or lowering the tax by 2 to 2.5%, will lower the friction in the market and increase the efficiency. So that's the cost dynamic. And I gave you the productivity dynamic around agentic AI, smart contracts, API to API transactions, including very small transactions.
I know ARK has made a bet on Tom Lee's Bitmine. Of course, I'm asking one of the largest ETH treasuries right now. I mean, unpack that a little bit more for me. Is that related to what you were just telling me about agentic AI and smart contracts? Do you see Ethereum as being the foundational layer to enabling a productive agentic AI world?
Yes, we have been watching carefully who is signing on to what protocol as they begin to develop their digital asset strategies. So, well, first we saw Coinbase, for its layer 2 base, chose Ethereum. More recently, we saw Robinhood, for the layer 2 that it is evolving, also building on top of Ethereum. We had a thesis that Ethereum was going to be the institutional protocol. I know that Solana was doing much better. Solana had a massive run relative to Ether. And so many people were challenging that notion, and yet we're seeing the votes being placed. And it makes sense. Ethereum, while it might be higher cost and a little slower, it's more decentralized and therefore more secure. Solana we think is probably going to be the winner in more consumer-facing applications. And it was very, very difficult for us to gain a position in our ETFs with good exposure to Ether. There are all kinds of problems when 40 Act funds buy another fund, another ETF to gain exposure. There are tax issues. There are fee issues, fees upon fee issues. There's something called, and this is a tax issue, bad income. If let's see, if the profits associated with something generating bad income, bad doesn't mean evil at all. It just means it's a tax term. If those profits, gross profits, this is gross, there's no netting here. If those gross profits are more than 10% of the total profits generated in a year of a fund, the entire fund can be shut down. The tax benefit, you'll basically you'll lose a lot of tax benefits, and you'll be subjecting the fund to a great number of fines, if not actual shutting down. So we can't take those risks. And as you can tell, I'm not deep into tax law, and I'm not going to be able to explain exactly what, who, what, when, where, why, and how. I just listened to our trading team, our compliance team, our finance team, and I say, okay, I can't go there. It's just, I can't do it. So this is the first time we've been able to gain a solid position in Ether. And, sure, it comes at a premium. But what's different from Bitcoin treasuries, like MicroStrategy, now Strategy, is there's just more utility that these Ether treasuries can offer, staking being one of the most important ones. The ETFs, at least not yet, the Ether ETFs are not allowed to stake. Mm-hmm. So, and yes, I think as you know, we were the cornerstone investor in Circle. So we've been watching the stablecoin movement, which is exploding. And of course, again, most of that is happening on Ethereum.
Has it changed your perspective on Bitcoin at all? I know that your outlook there is a $1.5 million Bitcoin by 2030. Has that changed at all?
So when people ask me what is the biggest surprise in the last 10 years, so we started ARK in 2014. We wrote our first Bitcoin blog back then. 2015, we wrote our first white paper on Bitcoin. And we thought that Bitcoin in emerging markets would serve the role that stablecoins now are serving. And Tether is just an unbelievable story that way. I just learned from one of the founders of Tether, Paolo, that they had no idea that Tether would become an important source of dollar exposure to emerging markets until COVID, when the children of in families in emerging markets would go to their parents and say, you don't have to go into the black market today to buy dollars. We can do this on the internet. And that's how it really spread, which is fascinating, isn't it? We thought Bitcoin would serve that role because we didn't know about stablecoins. And even very recently, I think we're becoming very surprised at how quickly the uptake of stablecoins is. So if we had to modify anything in that $1.5 million forecast, you'd probably see and you can see on a table in Big Ideas 2025 how we build up the bull case. We'd probably take a little bit from the emerging market part of that stack, but I think the much bigger force right now is it's the gateway into digital assets for institutional. It's a new asset class that and the really substitute for gold as a store of value. another use case. Those are the two biggest, and those we have not changed at all our opinion on. So I think we can safely say that our bull case is well over $1 million in 5 years.
Talk to me a little bit about, I mean, obviously Bitcoin, it sounds like with all the innovation that's happening in the digital asset space, you're starting to look at things outside of Bitcoin, which may have gone to the over $1 million by 2030 instead of the 1.5 million by 2030. What are, let's say, the top protocols or projects you're watching in crypto right now?
Okay. Well, again, because we're primarily in the public markets, and because I think one of our roles, just like one of CoinDesk's role, is to really educate. So we are watching our clients and guiding them carefully into the ecosystem. Bitcoin, Ether. We do have private funds, which had a very heavy weighting in Solana relative to ETH until recently. And we made a very good move at a good time as Ether started to outpace Solana. So those are the big three for us. And we're watching layer twos, of course, as well. And I think you'll see us, as we're trying to educate our primary client base, go more deeply into, the big three, talking in terms that financial analysts and investors will understand, looking at returns relative to risk, calculating the Sharpe ratio, the Sortino ratio, and so forth. So I think that's what we're really doing right now in terms of, from an education point of view. That paper is in process. And the other thing we're going to do, like we have done with Bitcoin, so we put out something called Bitcoin Monthly. It's probably going to be Bitcoin bi-monthly, and we're going to layer into the alternative months Ether, Solana, and then the longer tail. So, and what this does is analyze on-chain or look at and evaluate on-chain analytics, as again we educate our investor base about the kinds of signaling properties that these protocols have that we don't have in equities or bonds, because the transparency just isn't there the way it is in blockchain technology. So we'll do ETH, Solana, and others as time goes on, and as they begin to show themselves as interesting, especially to institutional investors.
You did your, I guess, top three crypto ecosystems there. When it comes to crypto equities, do you have a top three?
Well, you can see in our flagship, which is ARKK, in our fintech, ARKF, and I think this is also true in ARKW, which is next generation internet, includes both crypto and AI. So that agentic AI theme. The two in the top 10, there actually are three in the top 10 of certainly the F and K: Coinbase, Circle, and Robinhood. Robinhood is not a pure play, but as we've watched, and I'm going to say about 3 years ago, our questioning when we had our quarterly calls with Robinhood was all around crypto. Your client base wants it. Where are you? Where are you? Are you building out your infrastructure? And at a point, we pulled away because they pulled away. And of course, now they're at full throttle. If you saw their analyst day and the debut of some of their crypto offerings, I think they're playing to win big.
So no MicroStrategy in that top three.
Well, no, because as I said before, with MicroStrategy, yes, that is a bet on Bitcoin. That's obviously the biggest asset in the space. we feel certainly that Coinbase is is powered importantly by Bitcoin, because where Bitcoin goes, others follow. So we felt that we had a good broad-based holding there. And as I said, Bitmine immersions is not in the top 10, but we do think it's important now that Ether is showing up as an institutional preference, that it's important for us to be there.
Cathie, I really want to get your perspective here because you've really made a career on betting on the future and your ability to see into the future and make big bets on technologies like that we've discussed that many are just really trying to understand where they are going to sit in the world. And when it comes to Bitcoin, there's this narrative that quantum computing may threaten Bitcoin's security. And now that I have you here in front of me, I'm really curious as to your perspective there. Do you think that quantum computing could be a threat to the Bitcoin ecosystem?
So, of course, we think about this a lot. And in fact, we have our former director of research, we bumped up to chief futurist, because these kind of existential questions are so important. And, he and our team, especially our crypto team, David Puel, you may know him from a number of metrics in the Bitcoin on-chain analytics world, are named after David. He created them. So he's very interested in this question as well. So Brett, our chief futurist, and David have been evaluating the breakthroughs that we're hearing about. And there are breakthroughs, but they are small steps to, something that could become explosive. When do we think that will happen? Brett truly believes it won't happen until the late 30s or 40s, if it's going to happen. And one of the reasons is because the progress in AI today is so rapid, so much more rapid than I think even we expected. And we've been watching this since we founded the firm and before, that some of what many people were looking at quantum to accomplish, AI is going to be able to accomplish. And, I mentioned how quickly the costs are falling, but the speed at which AI is evolving technologically and not reaching sort of an asymptote in terms of performance, it just keeps going up the more compute power we throw at it. I think that's the more important theme right now, and will forestall a lot of capital moving into the quantum world. We want to see how far we can take AI.
You mentioned these existential questions that you and your colleagues kind of ponder while you're putting together your theses. What are some of those existential questions that keep you up at night?
Well, I'll tell you what was keeping us up at night. It was just the horrible regulatory trajectory we were on in the last 4 years. It was, we were beginning seriously to look offshore for more and more, to source more ideas, because we thought, especially in the blockchain space, because the innovation in the US was being absolutely stifled. And when you think about what blockchain technology is, it truly is the next generation of the internet. You see how the internet led, or because of the internet, the US has led the technology revolution. We were going to be dealing ourselves out of the next generation of that revolution, which is going to be bigger. So that, from a US point of view, and from an investment point of view, the rest of the world is a lot more fragmented in many ways. Certainly going to Europe, sure, there's the European Union, and then you've got all of these pockets of other regulation, and you've got geopolitical risks elsewhere. So I think that was quite a concern, and we were very vocal. I remember saying, I remember saying, I think it might have been on a broadcast, but it may have been on a webinar like this. While he was in office, I remember saying that Chairman Gensler was a menace to innovation. And then I got off of whatever that was and said, whoops, we are regulated by the SEC. I wonder if they could come back at us because of that, because there was a lot of vindictive behavior as well. So we wanted to make a stand, and we needed to make a stand, because this was so vitally important to us and to, technology companies in the US. And yet there were risks associated with it. So when I say existential, I mean business risks.
Did you get any? Did the SEC say anything to you about that, or did you get any flack for that?
No, I didn't, and we didn't. I will say, like all investment firms, the SEC reviews us, does examine us. And I think because of what we do and how we do it, meaning we were the first to give away our research on social media, to post our trades every day, to be out there talking about our portfolios. And we can talk about our portfolios because we disclose them at the end of every day, whereas mutual funds don't. So all of this was considered very risky. Very few investment companies wanted to go there because they did not want the SEC examining them for those reasons, among others. And we knew we would be examined, and we knew we had to be airtight. And I think, our chief compliance officer, he spent 4 years at the SEC as an examiner, and we took it that seriously. I think the SEC, if I might say so, I don't know for sure because they never tell you. You never know when an exam, if it's ended, if everything's okay. They don't give you a letter saying that. If you don't hear back from them, great. Well, I think that we've gone through enough of exams or mini exams that they know that we know we have to be holier than thou from a compliance point of view.
Talk to me about the importance of, sharing as much as you do on social media and sharing your trades, making that information public and accessible in a way that many of your competing firms do not. Why is that so important to you and at the center of what you do?
After 0809, we were watching trends in the financial markets. And I remember at one of our brainstorms at my last firm, one of the trends we were observing was mutual funds losing share to ETFs. And I wanted to know what an ETF was because they were only used in the passive world, not in the active management world. And we're active investors, we trade every day. Whereas passive rebalances maybe once a quarter or twice a year. And when I learned what it was, I said, well, why can't we put an active fund inside an ETF wrapper? And I volunteered to do that at my last company because they got exemptive relief to do just that. And I realized two things. One, this was going to be disruptive to the mutual fund world because the fees in the ETF world are much lower when you count all of them up. There are a lot of hidden fees in mutual funds, whereas ETFs are just much more transparent in every which way. So I think the reason ETFs took off and the reason we have done very well is we were responding to the market's demand for transparency. They needed to be on the journey with the manager because they had lost a lot of trust in the financial markets in 0809. And we understood that. And we also wanted to do something that other asset managers weren't doing. Many were becoming much more benchmark sensitive. If they weren't going passive, they were going benchmark sensitive, which means they all started looking alike. You look at all the large cap growth managers, no matter who they are, they're probably going to have a lot of the Mag 6 right at the top. We do not. We're a diversified exposure to disruptive innovation. But so what we wanted to do was say, we're not doing that. We're trying to give you exposure to the way the world is going to work. And, some of these very successful companies, they helped build the world as we know it. If there's all this disruptive innovation taking place, technologically enabled, some of them are going to be disrupted. Some will be able to adapt, but we will go to the pure play disruptors for our largest positions. And so that's how we've blazed a trail. It was not a popular strategy. I would say for about 3 years, 21, 22, 23, and part of 24, because the market it was a bull market, but it was concentrating towards just a few stocks, especially the Mag 6. And we were characterizing that as, yeah, you might call it a bull market, but it's not a healthy bull market. A healthy bull market broadens out and benefits many other companies. That's what's happening this year. So your original question is, why did we decide to do it this way? Demand for transparency. We wanted to bring our clients along with us for the journey. We had no idea during 2020 how that would blow up, because everyone was at home and they didn't have much to do other than maybe shop online and invest online, right? And here we were giving research away, we were posting our trades, and there were YouTube videos about our trades, about why we were trading stocks. We had no idea about these videos all around the world, especially in Asia. So we grew a global brand because we were willing to do something that helped people. And I think our openness, especially during COVID, I remember in March and early April of 20, we developed a point of view. And as I just described, my background is economics, and I feel it's really important to have a point of view. It may not always be right, but you have to have a point of view and be open-minded. So during COVID, I was just doing, I was doing economic models in my mind and on paper saying, wait a minute, massive monetary stimulus, massive fiscal stimulus, everyone's at home. Their savings rate is exploding. I think the saving rate got up to 27%. Now it's around 4 or 5%. And I said, it seems like this is a recipe for a boom and supply chain problems, because we have this virus going. And that's exactly what happened. And it caused a lot of problems, a lot of volatility, a lot of consternation. The Fed taking rates up the way it did really, really was very difficult for any companies with this innovation mindset, particularly if it didn't involve the Mag 6. It's not like the Mag 6 aren't going to participate. They're just not pure plays anymore.
We're running low on time, but I have 2 more questions I want to get to you. The one is back to those existential ones. We were talking a lot about AI. You think a lot about how AI is going to develop now and into the future. Do you ever think about how AI might outperform ARK or may outinvest ARK? Is that a future that you think about and that you plan for?
So I'll answer that question in a couple of ways. I think the low-hanging fruit for AI is in the passive / benchmark sensitive place. And that's where many investors moved as the Mag 6 seemed to be the only thing working, right? And so I would be more concerned about benchmark sensitive strategy or quant strategies. Quants using factor analysis, slicing and dicing. It's interesting and I don't know how quant oriented your user base is, but when quants look at our strategy, they're unable to define in terms of the various factors factors they have used as categories. So growth, quality, which typically means lots of cash and cash flow, volatility, profitability, different factors. When they get to our strategy, there's a huge percentage in what's called residual. We can't explain this. That the reason they can't is because the future's not going to look like the past. And we're invested in the future. And so quant is all about the past. So that's a good thing. That's a good thing. So I think quant-based strategies will be overtaken by AI. They'll be completely commoditized. They're heading that way anyway. Our strategy demands original research, and we give our research away. We can feed it to OpenAI, Grok, the large language models, and there's a certain pattern recognition they will be able to discern. But that will help us and take us to the next level. We won't have to spend as much time on that anymore. And I'll just give you the centerpiece of that is Wright's law. So Wright's law is a relative of Moore's law. You've heard of Moore's law in the semiconductor space. So twice the power at the same cost every 18 months to 2 years. Moore's law is a function of time. Wright's law is a function of units, the number of units produced. The more the units are produced, the more costs fall. And so getting that cost decline right, which we use Wright's law to do, is really important. I think AI will really help us with that. This is painstaking work. And then we'll see how that leverages us. I would not discount human ingenuity, especially our research teams.
And I want to end the interview where we started, Cathie. If you were going to go back and talk to that 20-year-old you who was exploring every different program, what would you say to her?
Oh, I would say good job in terms of being open-minded and not panicking. I did go through and just enjoy the process, really. So definitely if you do get to college without an idea of where in the world you're going, then that's the time to sample as much as you can, anything that interests you. Because, I have found, with people who have joined our firm, with my own life, if you lean into what you love learning and, want to be a part of that ecosystem, your life is going to be very enjoyable. I'm not going to say it's stress-free, but on balance, I still love what I do. I love it. I love it so much. And, all the seeds for what is happening in innovation now, all of those seeds were planted in the first 20 years of my career. And so I've had the privilege, luxury, honor of watching them germinate and now seeing them flourish. And I'll just end on this, just to give you a sense of investor psychology. In the late 90s, a lot of these seeds were planted. Capital was just flowing, money was being thrown at anything .com, internet, biotech, anything like that. And, we knew it was too early. IPOs were coming out, the price would quadruple on day one. We said, that's crazy. That's crazy. These technologies aren't ready yet to scale, and they're way too expensive, which is one of the reasons. DNA sequencing, first human genome, it cost $2.7 billion to sequence one person's genome. That was in 2003. It finally was done. Today it's $200. It's ready to scale. And so what's the worst performing sector of all in the innovation space? That sector. And it just gives you a sense of crowd behavior. When you see, the money is just so easy to make, you could throw darts and become very wealthy. That's usually a bubble, or it's heading for a big correction. When you see a time like you see now, where there's a wall of worry, people are worried about everything, and and they are not throwing their money at one of the most important areas in AI, healthcare. It's the most profound application of healthcare. When they're not throwing their money, then you know we're moving up a wall of worry, which is a very healthy bull market. And what do you know? It is broadening out, which is very exciting. And we're really happy that blockchain technology is a part of this movement, this broadening out in the traditional financial world, getting exposure to this new asset class. Really important.
Blockchain really is broadening out and is becoming much more mature. I appreciate you taking the time to sit down with me. Thank you so much for joining and providing that insight, Cathie.
Thank you, Jen. This was fun. Memory lane.